Yeah, welcome everyone. Today I want to show us something very interesting, and I want to take us into a journey. It's going to be a journey of gaps, how to treat market gaps. I know I've done a video already on how to treat gaps on boom and crash, but this is one of the best video you can ever get on how to trade market gaps. Now I'm going to be considering all the gaps entirely. I don't want you to skip any part of this video because it's going to be a journey, and I will be showing you how to understand gaps and how to take advantage of gaps. I will be teaching us the different strategies, as time permits me, at least 4 strategies on how you can trade gaps. 4 strategy. I think I've been only teaching 1 strategy on how to trade gaps, but this time around I'll be teaching 4 different strategies on how you can trade gaps, and then I'll be teaching us and showing us the technical tools that we can use, and also the indicators, technical indicators that we can use in order for us to trade these gaps. Then we are going to look at some common pitfalls and risk management as regards trading the gaps. Now just follow me on this journey, guys. Follow me on this journey, and I'm very sure you will not regret watching this video. You will not regret that your path has come across this particular video. Now before I go into this training, if you have not subscribed to this channel, take this moment to subscribe to this channel. Just click the notification bell at the top left corner. Just click it, and then click the subscribe button. Give us some comment and some likes, and you can as well recommend this video to others by sharing the video to them, your loved ones and your family and friends. Now let's quickly go to the business for today. Gaps. Now I want us to understand something very important, that gaps actually occur when the price of a financial instrument opens significantly either higher or lower than the previous close, creating what? A gap. Now if a price open or close significantly below or above the previous price, it creates a gap. Now for example, look at this particular trade here. You see it closes here, and all of a sudden there is a gap between here and here. There is a gap between here and here, and we saw that the market still continue after the gap. Now there are gaps that the market might not continue. Okay, look at this gap. Look at this. Closes here, and then it opened at this particular. You see, this one is a massive gap. It's very massive. It's very massive. Now when price actually close, that's the final price or the closing price, actually is higher or lower than the previous. But you see, the major thing here is that it has to open significantly either higher or lower. Now you see that this close at this place, but significantly open in a lower price, which is this particular place, creating this gap here, this massive gap. Now you can see many gaps. Okay, look at this. Even though it's not significantly downward, but you see there is a little gap here. There is a little gap. Now this is the gaps that we're talking about. How can you trade these gaps? Because this gap, you always see it on Mondays. In fact, I think after this video I'm going to do a video on how you can make maximum profit every Monday on forex trading. How you can make maximum profit every Monday on forex trading. Because if you can understand this gap, I will then chip in some technicalities to help you trade on Monday in order for you to make profit. Because most of this gap, it is on Sunday night / Monday morning that you will see this gap coming up. Now this is just what the gap is all about. This is just what the gaps is all about. Now, what are the causes of gaps? What are the causes of gaps? Now, there are times that overnight you begin to experience news. All this overnight news can actually create what gaps. Like if there is news in the night, knowing that nights are always season of low momentum, low volatility. So once there is a release of news at night, definitely there will be gap created. There will be gap created. And then when there is market sentiment shift. Now, when we're talking about market sentiment shift, we're talking about low liquidity at the particular hour. For example, let's look at an example. Okay, look at this example. Okay, this particular example, there was low liquidity. The liquidity was actually fading, and all of a sudden, in fact, it faded well. That's the result of this bullish candle that came up here. It faded well. So this bullish candle came now to let trader know that there is actually volatility in the current week. There is actually volatility for this particular pair. That's why we saw this, and we saw this engulfing pattern. Now, put it at the back of your mind that we have two things: when we have overnight news, and then when there is a shift in market sentiment. When there is shift in market sentiment, definitely you will see a gap. In your chart. Now, there are four types of gaps, which previously I have been teaching on only one type of gap. Guys, watch this video to the end. Don't skip any of this part. Don't skip any of this video. It is for your own good. It is for your advantage. It is for your understanding. It is for your own improvement in trading. It is what I know that I'm teaching us. Now, I'm taking this time now because to do this video, because someone actually requested me to teach him, and I said that if I'm going to teach you alone, I'm only going to impact you. I'm going to impact only one person with this knowledge. But if I can do a video now, I'm going to impact a larger audience with this knowledge, and they will understand how to trade gaps, and also how to navigate their risk management and their common pitfalls in trading gaps. Now, we have four types of gaps. Now, the first type of gap occurs in a normal market. Now, we call it common gap. These are the gaps that we always see, common gaps. Now, there is an example of common gap here. I saw it here. Yeah, here. This particular place here is an example of common gap. Now, this common gap actually normally happens when we have low liquidity. It happens in periods of low liquidity. Now, this might not have significant implication in the market. You see, it does not have significant implication in fact, the market continues in the selling direction. That's a bearish direction. You see it. So there is no much impact in the market. You see it. There is no much impact in the market. The market still continue the bearish movement. In fact, look at this. The next candlestick, you discover that there was no significant movement. So now the common gap does not have significant movement because it happens in a period of low liquidity. Then we have what we call the breakaway gap. Now, this breakaway gap normally happens when there is high volume in the market. Now, this signal that the start of a new trend has begun. There is actually a new world trend, and this happens most times also after consolidation. Let's see if we can get one of them. New trend. No, this one is not a breakaway. So it's not a breakaway. Now the breakaway, yes, no, this one is not a breakaway too. This one is not a breakaway. It does not signify. Okay, yes, here comes. Look at this particular one here. It's actually a breakaway kind of gap. This is a breakaway kind of gap. Now it signifies that there is actually a new trend. Now you see, after this particular one, it came, fill it up, and began to what? Sell. You see it, the trend changed totally. There is a change of trend totally. You see, this is a pure example of breakaway gap, showing us that there is actually a change of trend. Look at it here, showing us that there is actually a change of trend. And if you look at it here, you discover that this is also double top in a higher time frame. 1 hour time frame is a double top. Now this is another confirmation telling us that this is actually a breakaway trade. A breakaway trade, like I said, is a trade that tells us that there is a new trend entirely. There is a reversal in the market, a reversal of the trend entirely. Now this is actually a clear example. This is actually a clear example. Look at it. Look at it. It's actually a clear example. Look at it. And then we saw the sell. Actually a clear example. Now the next type of trade is the runaway trade. Now we see that here. The runaway trade. Where is the example? The runaway trade, yes, the runaway trade. Now the runaway trade is actually occurs to signify trend continuation. Now look at what happened. This was actually in a bullish movement, bullish trend. Now there was actually what? A gap, and the gap started with what? With a bullish what? Candle, signifying that this particular trend has not finished. This particular trend is still moving in direction of what? Of the bull. And look at what happened again. It continued moving in the what? In the bullish direction. In the bullish direction, signifying to us that it what? Is a continuation what? Gap. It's a continuation gap. Look at it here. Let me see if I could get another gap, a continuation. Now look at another gap here again. Look at another continuation gap. This particular gap here, you see it here, is actually a continuation gap from sell, and it continue what? It continue selling. You see it, it continue selling. It's actually a continuation gap. Now we have example. I've seen the example of continuation gap, which is runaway gap. Now the last type of gap is actually the exhaustion gap. Exhaustion gap. Now, like the name implies, exhaustion, it means that the trend has been exhausted. Now the market makers are tired of the trend. Now this kind of gap is very hard to be seen. Now meanwhile, even though it's very hard to be seen, we can actually we might get it. We might get it. Okay, look at this particular. Oh, this has gone back. Now we are looking at the exhaust. Okay, look at this particular trend. This thing gap. This is a pure runaway gap. Runaway gap. Pure runaway gap. You see it. It gives what? Trend continuation. You see it. This gap is for trend continuation. Is for trend continuation. Now that one is very hard for us to get, but once in a while we actually get to see it. The exhaustion gap. Now this appear near the end of a trend, when momentum is being faded in the market. Momentum is fading in the market. We tend to see what? The exhaustion gap. Now indicating potential reversal in the market. It indicates potential reversal. Once you see such kind of gap, exhaustion gap, you know that the market is about to what, reverse, and we can use our RSI and stochastic for us to confirm the overbought oversold of it, and then finalize our argument as regards it, whether we are buying or we are selling. Now that is as regards types of gaps. We just have 4 types of gaps. Now what is the significance of we now studying this? Now looking at all these gaps, what is the significance of we now understanding this? Number one significant I want us to have our back of our mind is that price moves as result of gap. There is actually price movement as a result of gap. There is price movement. Now gaps indicate strong momentum or sentiment shift. Strong momentum or sentiment shift, providing for us a clue about the next market direction. Because when you see a gap, you know where the market will move in the next week, where the market is moving now. Is telling you the next move of the market because of what? Because of this gap. That's one of the very strong significant that we must understand. Now when you see such kind of gap, and then you see that it fill up back here, you know that this one is actually a bullish gap. It's actually a continuation gap. It's a runaway gap is actually what? A continuation gap. So that's one of the significant. We understand what? Price movement. And the second one is that we understand, after we have understand the price movement, we actually take what? Opportunity of it by trading what? The gap. Now the gap can signify either an entry or an exit point for trade, depending on the types of gap that we are seeing in that particular pair or in that particular chart. It can form an entry or an exit. Now based on the context, now we're not going out of the context. Based on the context, if it is an uptrend, downtrend, so these are actually the context at which we will be able to know which type of gap we are dealing with. Then the next thing is psychological impact. Whenever there is actually a gap in the market, is actually a proof of psychological impact because of sentiment shift. Now retail traders, institutional traders, retail investors, and market makers will be able to know what is in their mind. That is what we call psychological impact. Now the gap often reflects sudden change in investor sentiment, which we can actually take advantage of it and exploit the market. Because once you understand it, you be able to take advantage of the market. Now I will soon share with us some strategies that we're going to use when we understand this, because we have already understand the 4 types of gap. Now I'll be teaching us. Now also we need to understand that one of the significance of studying this is gaps also gives us area of support and resistance. Why? Because gaps can actually act as future area of support and resistance. Look at what happened here. You discover that this particular place here is our support by the reason of by the reason of this gap. By the reason of this gap, we got we got a support. By the reason of the gap, we got a support at that particular region, just because of that particular gap. So you can imagine if that gap is not there, which means that support will not be there. But immediately that gap was initiated, support was given. Okay, look at this gap. Now this gap did not just give us resistance, but it gave us an order block. So take note of that gaps actually gives support and resistance. They can actually serve as future support and resistance zone, as often price normally come back to what, to fill the gap, or fill the, or to respect the level of that particular gap. This is what I've been teaching us, that gaps, price always respects the area of gaps, come back to fill in the area of the gaps, which is the normal thing I've been teaching us. So let's move on. What are the strategy and how can we trade these gaps? The strategy, the first strategy, I'm having 4 strategy because we're having 4 types of what, gaps. Now each of them have what, 1 strategy to trade. So follow me so that I will explain to you this particular thing very well, in order for you to understand it and then flow with me. So now let's look at the various strategies. Let's look at the various strategies for this gap. Now, like I said, 4 strategies quickly. Now the first strategy is the gap and go strategy, which I want to show us. The gap and go strategy. Now the gap and go strategy, now traders actually enter a position in the direction of the gap, expecting the trend to continue. Now this is mostly for the runaway type of what, gap. Now for example, we are now right in front of us is actually what, a runaway type of gap. And then in this gap, in this type, for us to trade it and make profit, you use what, the gap and go strategy. Now after this, you see it jump from here and open here. At this particular place, now you enter what, you enter your buy, and then begin to write the buy and move till the New York section of that particular day and make your profit. In fact, look at what happened. It was after the New York section that we saw what, we saw a reversal downward, and it continued moving what, bullish. You see, it went far bullish. So you can actually ride this, you can actually ride on this particular world trend when you understand this. Now this is the first strategy, the gap and go word strategy. Once it opens, once the price actually open in direction of the gap, you see it like this, open like this, you see the gap, or it opens down, and then you get a confirmation candlestick. Now you just know that this is actually what, a gap and go strategy. The next one, and this normally happen in our runaway type of what, gap. Now the next type of strategy is the gap fill strategy, which is the normal strategy that I've been teaching us. I've been teaching people the gap fill what strategy. The gap fill, why? Because that's for the common gap. That's for the common gap. Most times gaps are being filled. Gaps are being filled. Price normally come back to fill what, gaps. Now look at it, look at it. This is what I mean. You see, after this gap here, the next candlestick was what, so the next candlestick was another gap upward. Now gap, it came and what, fill these particular gaps. From here like this to here is a gap. You get it, from here to here is a gap. Now this is for a common gap because there is no much liquidity and volatility in the market, no much momentum in the market, so it has to come and fill up this particular gap here. You see, it fill it, this particular candlestick is the one, this particular candlestick is the one that fill up this particular word gaps, this particular gaps, before it continue moving for that word, for that week. You can discover this here. Before it moves ahead, it has to what, it has to fill up this gap. Now this is what I call the gap fill what, strategy. Now the third strategy is the fade the gap strategy. Now this involves trading against the gap direction, particularly for exhaustion what, gap. anticipating reversal. When you are anticipating reversal, you are you at the back of your mind, you are seeing that this particular trade is actually on reversal mode. Now you can go against, that is counter trend trading. You get it? But you are now doing that with a gap in mind. Are you getting me? Now, remember, I said that it is very difficult for you to see that kind of gap, but still it is possible, and it is real. It is tangible. You get it? So the fade the gap strategy is only when there is exhaustion of what? Of momentum in the market. So you can enter in direction of against the direction of what? Of the trend, because there is about to be what? Reversal. There's about to be reversal. Now, the fourth one is breaking what? Trading. The breaking trading. Now, the breaking trading, this has to do with the breakaway gap. Now, traders might not understand this very well, but I want to explain this so that we'll understand it to the possible means. Now, I want us to know that you need to, at this particular strategy, you need to wait for confirmation before entering a trade in the gap word, in the gap direction. This is what we call the breaking word strategy. This is actually the breakaway. That means moving away from. You get it? From the direction, that's from the trend. So you need to confirm this, and we have many ways to confirm this using some of the technical tools and the indicators, which I'm about to teach us now. So now, quickly, what are the technical tools and the indicators that will help us to understand these particular gaps and how to trade them? What are the indicators and the technical tools? Now, the first technical tool that will help us is our candlestick chart. The first technical tool is our candlestick word chart. When you see a dodgy or engulfing pattern, you should know that this particular gap will actually be valid. Will actually be valid. When you see engulfing pattern, you see it here. When you see it here, particularly, you should know that this particular gap will definitely be valid. It will be valid. And then the next is the volume analysis. Now, for volume analysis, we actually use the breakaway kind of gap, because this suggests unto us that there is actually strong conviction against the weak. There is actually strong conviction. That is why we have what? Breakaway. Before you break away from something, you have to be strong. Like somebody is holding you, for you to break from that person's hand, move away from that person's hand, it means that you are stronger than that person. So that is one of the confirmation. There must be volume analysis. Now you check if it is which kind of gap that is there. If it's a breakaway gap, then you are good to go. You understand? You are good to go. It's actually going to be valid also. Then we have moving averages. Remember, moving averages help us to know the direction. Like you see my chart, I'm having moving averages. Help us to know the direction of what? Direction of price, the trend, direction of the price. Now you see the 200 moving average, the 50 moving average, and the 30 moving average. Now all of these are my trend indicators. They help me to know the trend of the current trend and the previous trend that I'm having per chart. Now this is moving average. It helps to identify trend. We can also use support and resistance, guys. Support and resistance, because most times gaps mostly happen near key levels, and tools like Fibonacci retracement can help us to predict where price might move. Tools like Fibonacci retracement can help us to know the next move of the market. How? Now let me explain to us. Let me reduce this so that we'll see it clearly now. Now look at this quickly. Now let me pick my Fibonacci tool. Let me pick my Fibonacci tool. Look at it. Look at it. You see, Fibonacci now is telling us that price definitely we return back to the 61 moving average, or the 61 level or the 38 level, and you see it actually returned back after reaching the 61. It came down to what, 38 level before what, moving up. So we can actually use this particular level, Fibonacci retracement zone, in order for us to know what is happening. Okay, look at this particular one. Look at this particular one. Fibonacci, very powerful tool, guys. Look at it. Now you see at exactly 61 level, look at it, at exactly 61 level, there was a what, there's a retracement downward at exactly 60. So with this particular indicator, we can what, get a perfect support and resistance that will help us to trade. Now we can also use our oscillators. Now look at our indicators. Now we can use our oscillators. I just talk about moving average and the rest. We can use our oscillators, either our relative strength index or our stochastic indicator. Now look at it. Look at it. You see, stochastic indicator or RSI. You can use it in order for us to know overbought and oversold in the market. That's support and resistance, which have tendencies of what, of reversal. You get it? They have, once price reach oversold, overbought, it has what, tendency of what, of reversal. It's very simple. Look at it. Look at it here. Look at what happened here. Price reaches here, over what, overbought. There is high tendency, so it's sold. You see it, it's sold. And you see when price reaches down here, there was a tendency that it bought a little bit before what, continue the sell. When it reaches here again, it buy. Look at it. You see it, it bought. You see it, there was a buying, you see it reached here again, oversold, there was a selling. You see it. So price always respect this. Meanwhile, this indicator that you are seeing here on my chart is the TDI, that's traders dynamic index. This is a combination of many indicators, combination of many things, which is another thing entirely, which I think I will spare time so that I will do a complete video on that. Now after using you can use your RSI, like I said, and then your stochastic indicator, and then your Bollinger Band. Why? Because Bollinger Band normally show us when there is volatility in the market. Now I don't usually use Bollinger Band most times because I have my TDI here. I have my TDI, so I don't usually use the Bollinger. But meanwhile, this is the Bollinger Band. This is the Bollinger Band is actually a trend indicator. Is here. Look at, you can add it up. Just click here, add it up, and then you see it will look like. See my own. Look at it. So I don't usually use it, even though I've done video on it. I've done video on the indicator. You can actually learn and then trade with the Bollinger Band indicator. It's actually a very powerful and a very good tool for you to trade with. Now let's move on. The last thing that I want to share with us on this gap, the issue of gap, is risk management and common pitfalls that people usually have. Risk management and common pitfall. Now most times people, that's as regards risk management, people don't usually use stop loss. It's actually good for you to use stop loss at least 25 pips below or above the nearest support and resistance. 25 pips. Why? Because you know that this particular gap actually behave unexpectedly. Why? Because there is volume in the market, there is volatility in the market, so it can behave in an unexpected way. Now you need to put stop loss orders. And then the second thing that will advise us is that now you have to consider the position of what you are the position and the size of your lot size. Now, based on your account, let your position and your size, your lot size now matters. Please take risk management very serious. The position and the size what matters. The size of your lot size and the positions that you open. Avoid over leveraging, as gaps can be what volatile and lead to rapid loss. So avoid what leveraging, over leveraging. Please avoid it. Now, the risk reward ratio that I always advise people when they are trading gaps is 1 to 2 reward ratio. Now, what is the reward ratio? Now, for example, you are selling this now. This should be your point. This should be your take profit here. Don't wait until it reach here or pass here. No. Use your wisdom. Use your wisdom. 1 to 2 reward ratio, guys. 1 to 2 reward ratio. 1 to 2. Now, you see this? You are selling. What will be your reward ratio here? Once it reaches here, this particular place, you close your trade. You see, don't wait until there is a reversal. Don't wait until that, because these things cannot be predicted like you are the supreme. No, it can misbehave because of volatility. It can misbehave. So you use good reward ratio, but at least 1:2 is very good. 1:2 is very good. And what are the pitfalls now? Chasing gaps. Please. Now, don't always chase gap. That's entering a trade too late after a gap without confirmation can lead to what? Can lead to loss. When you enter gap without confirmation, in fact, you enter the gap too late without confirmation, you need to confirm first. That means you need to be awake most at times when the gap is being formed. You need to be at the spot so that you can actually analyze the gap before entering the gap. A gap that you don't analyze before entering is a gap that will actually blow your account. Is a gap that will blow your account. So you need to what? Stop chasing gap. And the second one is ignoring context. Ignoring what? Context. When I mean by context, I'm talking about the broader view. That's the trend. If it is uptrend, downtrend, you need to consider it. Consider volume, consider news, economic calendar. You need to be versatile in that so that you won't be able to go against it. Please put at the back of mind. If you are going against the context, it means that there is tendency for you to blow off your account. High tendency. So you don't need to ignore context. And then over trading, don't over trade. Gaps are exciting, but without discipline, you can lose out. Why? Because of over trading. So when you have reached your specific trade for that particular day or for that particular week, go off the market and rest. Don't overtrade. Don't overtrade. Overtrading can cost a lot in your trading career. Don't overtrade. And the last is when you neglect news. We know how news are volatile. We know how news are. News can cause your account to be empty entirely. So please don't over neglect news. Don't, even if it is not a strong news, please don't over neglect news. Now, thank you so much for watching this video. Do well to subscribe, click the notification bell so I'll be notified whenever I upload a video. So that's it. Thank you so much. See you in the next video. Kindly share this video with your family and friends. Thank you for watching this video. Do like, share, comment, and subscribe to this channel for more information.